Guys, how are you? Okay, first of all, congratulations for submitting your MyB assignment. I think you put a lot of hard work in finishing the assignment. Most of you already submit the assignment, but I also received some requests for extensions, which is very normal. We always have this kind of situation every semester. Okay, so in case you want to know how I will mark the assignment, so the total marks for the assignment is 15. Okay, so 15 total marks. So if you submit full 6 reports, you will automatically get 6 marks. Okay, so 6 marks will be given to you based on the completeness of the submission. Okay, so regardless of the accuracy of your assignment, if you submit the full 6 reports, okay, the balance sheet, profit and loss, to reconciliation, okay, and some other reports, you will get 6 marks. Okay, and the remaining 9 marks will be given based on the accuracy of the reports. Okay, so I will check 18 account randomly in the balance sheet and profit and loss statement. Okay, so each correct account you will get half marks per account. Okay, so if you get all correct, you get 8 marks in total. So 6 plus 9, you get 9 marks in total. So 6 plus 9, you will get 15 total, 15 marks in total. Okay, so the account that I will check mostly an easy account, like for example, the bank fee expense, basically only one transaction involved in this account. So I believe most of you will get this account correct. Okay, only few of them are very difficult account, like for example cash. So for cash, I know it's a bit difficult to get the correct balance of cash because I think there's more than 10 transactions involved in cash. Okay, but mostly the account that I will check is easy account. So I think in general, most students get half of the 9 marks. So in total, you get more than 10. Okay, in total marks. Okay, so I think it's very good experience that you use the MyB. So MyB is very popular accounting software for small businesses. Okay, in Australia, New Zealand, and in any other countries as well. Okay, so it's very good experience to have a hands-off experience to use the software. Okay, and then big companies mostly use more sophisticated software like Oracle or PeopleSoft. Okay, so they combine accounting, bookkeeping with some enterprise resource planning software. Okay, so congratulations once again for finishing the assignment. So next, if you have a LinkedIn account, you can add MyOB software in your skills. So if you click this add new skill button in the corner, right corner, and then you will find this search panel in the type MyOB, and then you can add this MyOB in your skills. Okay, so you can also ask your friend to endorse this your skill. Okay, so you can also ask me to endorse it. Okay, I will be happy to endorse your MyOB skill in LinkedIn. Okay, so I think LinkedIn is very popular if you want to apply for a professional job once finishing your degree at UTS. Okay, so the company or the headhunter will check your LinkedIn account, okay, as part of the screening or the application process. Okay, any comment or questions on the MyB assignment? So the mark will be available roughly in 2 weeks. Okay, so I think Amazon will upload the marks on the UTS online, so you can check it 2 weeks from now. Any comment or questions before we start? No? Okay, so our topic for today's tutorial is about ethics. This is, I think, very simple topics. So I think we can finish less than 1.5 hours today. So what is an ethics? So ethics is simply taking decisions for the right moral reasons. So if we talk about ethics, mostly we use moral standard or moral compass as our.
Sorry, sir. Before we begin, I just have one question. I can't find the quiz that we're supposed to do for homework. So I was just curious.
The quiz for what?
For the homework, I can't find it for some reason. Chapter 16.
Ah, okay.
Because the textbook only reached up to chapter 13, so I was confused, sir.
Ah, sorry, I forgot to tell you. So we use the other books, which is the blue one, is the managerial accounting books, not the orange book.
Oh, okay.
Yeah.
I see why. Thanks, sir.
So yeah, so from this week up to the end of this course, we will use the blue one, the blue books, the management accounting textbook.
Okay, thanks, sir. Then is it all right if I submit it to you after the tutorial?
Yeah, no problem. I will not check this week's homework.
Oh, okay. Thanks, sir.
So no problem. Okay, so back to the definition. So ethics is taking decisions for the right moral reasons. So we use moral standard as our main benchmark in evaluating whether this is ethical or unethical. And then taking into account the wider needs of stakeholders. So I think this is very relevant for public accountants. So auditors or public accountants should take into account wider users of financial statements. So when they decide to give some certain opinion, they have to think about what would be the employees, the investor, the creditors' perspective of this opinion. Okay, so they have to work actually on behalf of the public, the general public, not only for the company. Okay, so moral reasoning and take into account of the needs of wider stakeholders. And one important concept that we have to know is that legal is different with ethical. Okay, so in legal, we use the law as the benchmark. Okay, so basically in the law, law wants to regulate certain behavior and to prohibit certain behaviors, right? So they have punishment, they have prohibitions. Okay, but law is limited. Okay, so we always have something which is unregulated in the law or unclearly regulated in the law. Okay, so yeah, so always there's uncertainty within the law. So we always call that area as gray areas. Okay, but ethical, we use moral standard as our benchmark. So moral is more universal, more general and broad. So basically, moral or ethical could fill in the gap in the law. Okay, so if there's some aspect or some issues which is not regulated in the law or unclearly regulated in the law, moral could be used as one of the standard to judge or to evaluate the ethical consideration of certain condition. Okay, so basically law and moral is complementary. Okay, so moral can fill in the gap within the law, okay, or the gray areas. Okay, so our discussion mostly based on moral, okay, because in accounting, mostly the accounting techniques or accounting policy, accounting choices is all legal. Okay, see, it's all provided by the accounting standard, okay, which is legal. Okay, but sometimes when the company choose certain policies or certain accounting choices, it could be unethical. Okay, for example, if the company want to manage their earnings, okay, they may choose certain accounting standard to report high profit. Okay, that is legal, totally legal, but sometimes it will become unethical. Okay, so we will discuss mostly about moral, not the legal standard. Okay, so in accounting, we have a certain standard of ethical behaviors. So we have Accounting Professional and Ethical Standard Board, the APES standard. Okay, so we use this guidance or this standard as our frame of thinking in evaluating certain accounting policies or accounting choice as ethical or unethical. So we have 5 principles. Okay, so we start with the principles. So we have 5 principles of ethics. The first one is the integrity. So integrity simply means being honest and straightforward. Okay, so accountants should be honest and straightforward in doing their job. And then objectivity, accountants should avoid bias, conflict of interest, and the undue influence of others. And then professional competence and UTS. So accountants should have sufficient knowledge and skill to do the job. Okay, and exercise the job in high level of accuracy. Okay, so minimize error and high level of accuracy. And then confidentiality. So the most of the financial information are confidential. So accountants should respect this confidentiality provisions. Okay, so they only disclose certain information if the government or the court asks them to do so. Okay, so confidentiality is very important. And then lastly, we have professional behavior. So accountants should follow the accountant professional standard. Okay, and then also follow the laws and regulations. Okay, so those are 5 ethical principles, okay, based on the APES standard. Okay, so next we have the threats. Okay, so threats basically certain condition or certain situation that could put the principles at risk. Okay, we also have 5 threats based on the APES standard. We have self-interest. So basically, if the accountant have his or her own interests other than the profession interests or the client's interests. Okay, these interests could be financial interests, business interests, political interests, or any other interests. Okay, which affect the accountant's behavior. Okay, so because of this self-interest, the accountant could be less objective, okay, and make some biased decisions. Okay, and then self-review. Sometimes the accountant need to evaluate or examine his or her own project in the past, okay, or his colleague projects within the same accounting firms. Okay, so this kind of self-review could make the accountant become less stringent, okay, and a little bit loose in evaluating the project or the works. Okay, and then advocacy. If the accountant has some specific issue that they want to advocate with the company or the clients or with any other stakeholders, okay, they might become less objective. Okay, and then intimidation. If there's an intimidation to the accountant, actually they can withdraw from the assignment. Okay, so if an auditor gets some intimidation from the clients or any other party, he or she could withdraw from the audit engagement. So basically, we should avoid any kind of intimidations. And lastly, we have familiarity. Okay, so sometimes the engagement or the audit activity has been going on for quite a long time. Okay, so like for example, if one audit firm have company A as an audit client for like 5 years, so the accountant and the owners of the company or the managers or the board of directors become familiar each other. Okay, so they become friends, and then as a result, the accountant become less objective and make some biased decision. Okay, so familiarity is a big problem or serious problem in the accounting professions. So in 2002, we have a big accounting scandals, okay, involving a big US company called Enron. So I don't know whether you know these companies. So we have Enron, a big energy company in the US. So this company making financial fraud for quite a long time, and the accountant, which is one of the big five at the time, the accountant just like giving the unqualified opinion. So they certify or they assure that the financial statement is okay, following the accounting standard, and there's no problem there. Okay, but in the end, the SEC, Securities and Exchange Commission of the US, found that this company has been falsifying the financial statement for quite a long time. Okay, so after this collapse, this company's collapsed, and also the audit firms also collapsed, which is the name is Arthur Andersen. Okay, so at the time we have Big Five. After the collapse of Arthur Andersen, now we only have Big Four. Okay, which is the PwC, Ernst & Young, KPMG, and Deloitte. Okay, and the US issued a new law, which is this, we call it SOX, Sarbanes-Oxley Act. Okay, which regulate that the auditor and the client should rotate the partners or the accounting firms once they reach the maximum engagement period. Okay, so we have a new concept called mandatory rotation. Okay, so if one company already been audited by this accounting firm or this partner for like, let's say 5 years, so the company should find another audit firms or accounting firms to do the audit for the next years. Okay, so there's a maximum period of engagement. So this law is widely adopted in around the world, even including in Australia. So in Australia, the mandatory rotation is 5 years. Okay, so if an Australian company already been audited by this accounting firm for 5 years, so they need to find another accounting firms, or they need to rotate the partners. Okay, so in order to maintain the objectivity and the quality of the audit process. Okay, so this is one way of mitigating the issues of familiarity, which is very, very serious in the accounting profession. Okay, any comment or question on threats and principles? I have a question from Rachel. Maybe Simon, will we get marked down if we did not add a cover sheet? No, cover sheet is not really important. Okay, so don't worry. As long as you submit these 6 reports, the minimum 6 report, you'll get 6 marks at the minimum. Okay, and if you get certain account, if you get correct balance for certain accounts, you'll get additional mark. Okay, next is the safeguard. So we have the principles, we have the threat, and now we have the safeguard. So safeguard, basically some procedures or policies could be implemented to mitigate the risk of the threat. Oh, before the safeguard, these are some examples of the threats in the auditing engagement. Okay, so the first one is the self-interest. It happens when the financial interest or other interests of the auditor or the relative are involved in the engagement or involved in the decision making, okay, in the auditing process. And then self-review, when an auditor evaluates a situation that is consequence of previous judgment or advice by the auditor or the auditor firm. So they have previous project or previous engagement which affect the current engagement. Okay, and then advocacy, when the auditor promotes a position or opinion to the point where subsequent objectivity might be compromised. Familiarity, when an auditor becomes too sympathetic to the interests of another party because of close relationships. Okay, and lastly, intimidation, when an auditor's action might be compromised by actual or perceived threat. Okay, I think the audit engagement is the most critical engagement. Okay, if we talk about ethics. Okay, now let's move to the safeguards. So in the standard we have 7 safeguards. Okay, to mitigate the risk of breach of the ethical principles. Okay, so we have education, training, and experience. Basically the same idea that the accountant needs sufficient skill and knowledge to do the job properly. Okay, so that's why they need proper education, sufficient training, and sufficient experience, and also professional development. Okay, so this relates to the professional competence. Okay, the professional competence of the accountants. We also have external reviewers. So sometimes the company need to hire another accountant to review the audit process or another assignment process from the external perspective, so they can evaluate the objectivity or the independency of the result. Okay, and then we have professional standard, which is the guidance that should be followed by the accountants. And lastly, we have the corporate governance. So corporate governance is very important. So company with good corporate governance, typically they will have lower risk of fraud or any other breach of ethical standard. Okay, so check and balance in the corporate governance is really critical. So we have these 7 safeguards. So in answering any questions about ethics in the final exam or in the quiz, you should frame your answer following the standard. So you start with the principles. So first you have to identify which principles may be at risk. Okay, given the case. Okay, so we have 5 principles. So you should identify which principles could be at risk because of the breach of ethical conduct. And next, you should identify the threats. What threat is appear in the case? Okay, so we have 5 threats. You should explain which threat will appear in the case and what kind of risk that it may bring to the ethical principles. And lastly, the safeguards. So you should propose appropriate safeguards, how to mitigate the risk of breach of the ethical principles because of this threat. Okay, so this is the way that we try to frame the answers following the APES standard. Okay, so please use this framework in the quiz or in the final exams. Okay, any comment or questions so far? Oh, okay, so that's basically the theory. So now let's move to the earning management. So I think the most interesting case of ethics is in the earning management activity of company. So how the company choose the accounting policy or accounting choices in order to report certain level of profit or certain level of asset. Okay, so this kind of choices may involve some ethical considerations, which is very relevant to our discussion. Okay, so I have three cases of earning management. So the first one, so we have CEO. So the CEO choose to extend useful life of a non-current asset. Okay, so he or she choose to extend the useful life of a non-current asset. What would be the effect to the balance sheet and income statement? So I think we have learned in the first tutorial that if the company extend the economic life of the asset, they will report, so in the profit and loss, they will report a lower depreciation expense. Okay, so we have learned that depreciation expense, if the company uses sideline method, is simply the depreciable value, which is the cost minus the residual value, divided by the economic life of the asset. Okay, so if we have a longer economic life, then we have a smaller depreciation expense, right? So this expense will be declining if the company choose to extend the economic life of the asset. Okay, so what would be the effect to the profit? So if they have less expense, it means their profit will be increased, right? So less expense, more profit. Okay, so the company could report high profit because of extending the useful life of their asset. Okay, so and what happened in the balance sheet? So in the balance sheet, if the company report a lower depreciation expense, they will also report a lower accumulated depreciation. Okay, so they will report a lower accumulated depreciations, and the result will be a higher balance of total asset. Okay, so total asset will be increased. Okay, because the carrying value or the book value of the asset will be increased. Okay, so by simply extending the useful life of the asset, the company could report a higher profit and also a higher total asset. Okay, and the question for you, whether this is ethical. Okay, whether extending the useful life of the non-current asset is ethical. Any comment or idea? So how we evaluate this kind of accounting choices or accounting policies as ethical or unethical? Okay, so no idea. So I think we can leave that.
Unethical, but legal.
Sorry, ethical and?
Unethical, but legal.
Unethical. Yeah, this is legal. So the accounting standard actually allows the company to choose the economic life, because it's only an assumption in the beginning. When they start using the asset, they have to assume, oh, this asset will have this long of economic life. So they can change that assumption anytime they want. Okay, so this is totally legal, yeah. But why you think it's unethical, CC?
Decrease is estimate of depreciation to increase the profit.
Mm-hmm.
How to say?
Yeah, it's okay. So yeah, so it depends actually. It could be ethical or unethical. It depends on the objective, okay, of the objective of the company, why they change this assumption. So you
sorry.
got something?
Yeah, I was just going to say, is it because it doesn't take into consideration the assets usage? So that's why it's unethical.
Yeah, could be. Yeah. So the general principle that we should remember when we evaluate whether certain accounting policies or accounting choices is ethical or unethical is this one. The accounting choices should reflect the economic conditions. Right? So any accounting choices or accounting policies should reflect the underlying economic conditions. So if we talk about asset, so if we can like verify that the performance of this asset is actually longer than the initial assumption of the economic life. So it could be an ethical policy to change the economic life of the asset. Okay, so we also have to see the underlying economic condition of the asset, right? So, but if this policy is only for reporting a higher profit or reporting higher total asset in the balance sheet, so that's obviously unethical. Okay, so you have to remember these broad principles of accounting choices. Okay, so I'll put. Okay, so you have to remember this. Okay, so let's move to the second case. So now we have if inventory price are increasing, so we have inflation in the economy. So the general price level is increasing and the manager wants to report the highest profit. Okay, so this manager wants to report highest profit as possible. So which inventory costing method would they select? Okay,
LIFO.
So,
It's a LIFO.
LIFO? Why LIFO?
Because older inventory the older the inventory is, the less value it is compared to the newer ones due to inflations. So by selling the older ones as the newer price because of FIFO, Australian standards usually accept FIFO as the main inventory method.
Yeah.
With some exceptions. But if it's LIFO and you sell the older product for a higher price, that means the profit you generate is much more higher than your actual book value. Your book value is much higher than your actual value.
Yeah, could be. Yes. But the selection of the method is not really clear, right? So the idea is like this. So if this manager want to report high profit, so he or she want to report the highest profit as possible. Okay, so what he or she need to do is he or she need to lower the cost of goods sold. Okay, so they need to make this cost of goods sold is lower than the previous one. Okay, so because the profit is simply the sales minus cost of goods sold minus the operating expenses. All right, so you get the profit. Okay, so in order to make the cost of goods sold is smaller, then they need to report a higher ending inventory. Okay, so ending inventory should be higher. Okay, because the cost of goods sold is the formula is the beginning inventory plus purchase minus the ending inventory. Okay, so if they have higher ending inventory, they will have a lower cost of goods sold and high profit. Okay, so they need to choose the method from these three alternatives, but LIFO at the moment is already forbidden in the accounting standard. So yeah, so they only have two options. But let's assume in this case they can choose three options, three methods of inventory valuation. So let's assume that the accounting standards still allow the company to choose LIFO method. Okay, so they need to choose which valuation method will give them the highest ending inventory balance. Okay, so given we have inflation in the economy, so the old stock, so the old inventory price will be lower than the new or the recent inventory price. Okay, because we have inflation. Okay, so the idea is that the manager should keep the latest inventory in the ending inventory and sell the old one. Okay, because the old inventory have a cheaper price than the latest one, the newest one. Okay, so which method will give this kind of perspective among these three? Is the which one? The FIFO, right? So if the company use FIFO, whenever they have sale transaction, they will sold the oldest one, so the oldest inventories, which is have a cheaper price, and keep the newest one, the recent inventories in the ending inventory. Okay, so the ending inventory balance will be higher, which is good because in the balance sheet they will report a higher total asset. Okay, because this ending inventory will be reflected in the balance sheet. Okay, so yeah, so they will report a higher profit and also higher total asset in the balance sheet. Okay, so the FIFO method will give you this kind of condition. Okay, so in the contrary, if we have deflation in the economy, which is quite rare, but now we have deflation actually. If the price of the inventory is declining and the manager wants to report high profit, then the manager should choose LIFO. Okay, so in the case of inflation, FIFO method is preferable because they allow the company to report higher profit, a lower cost of goods sold, higher ending inventory, which is also higher total asset in the balance.
So just to refresh my memory, the reason why LIFO is banned is because of taxation purpose, correct?
Yeah,
I'm not confused.
One of the
Okay.
reason.
Okay, so LIFO is for taxation reason.
Yeah.
Why it was banned. Okay, thanks, sir.
Yeah, so in the past, the company used different method for inventory valuations. Let's say in the commercial purpose, commercial financial reporting, they use FIFO, and then for tax reporting, they use LIFO method. Okay, so they have different profit level for tax and for financial reporting, right? So this is happening everywhere. So the new accounting standard, which follow the IFRS, ban this LIFO method. One of the reasons because of this tax incentive of using the method. So now we only have two methods actually, FIFO or the average. Okay, so the question again for you, whether this is ethical, right? So whether moving from LIFO to FIFO or average to FIFO when they have inflation is ethical. Okay, so again, you should remember this broad principle that accounting choices should reflect the economic condition. Okay, so if the company could justify these changes to FIFO, okay, that could be ethical. Okay, but if the sole objective of this accounting policy changes is only to report high profit, then that could be unethical. Okay, so the last one.
Sorry, sir. If
Yeah.
that's the case, but then doesn't the Australian government the ATO usually recommend people all businesses to use FIFO method? How is it unethical then? Unless they incurred the future sales, then that's unethical, right?
I think for tax at the moment, the company could choose whether they use FIFO or weighted average. Okay, at FIFO, LIFO is I think been banned for quite a long time for tax purpose. Okay, and then now the accounting standard follow the tax law in banning the LIFO method. Okay, so for tax purpose, actually the company have freedom to choose FIFO or average method. Okay, so yeah, they can choose which method is more preferable. And yeah, and then for commercial purpose or financial reporting purpose, they can also choose FIFO or average. So they can use different method for tax reporting and financial reporting purpose, but the discrepancy between these two methods is not really material as if we compare with LIFO method. Okay, I think yeah. So the ATO is neutral. The ATO is providing guidance for the company whether they want to choose FIFO or average method. Okay, so I think in that perspective, whatever option that they want to choose is still ethical. Okay, but again, for financial reporting purpose, we always have to evaluate the underlying economic condition. Okay, which drives the company to choose this method.
Okay, so thank you so much. So it depends on the purpose.
Yeah.
Okay, so LIFO, if used for the correct situation, it's ethical. But when it's used for the wrong situations, for specific reports, it's unethical.
Yeah.
It's
happened for every case. So it depends on the purpose and underlying condition. Okay, so the idea that these conditions will be reflected in the accounting numbers, okay, which is also affected by the accounting choices. Okay, one more case is now the company want to choose whether to capitalize the expenditure on a vehicle. So we have capitalized expenditure on a vehicle rather than choosing to record is as a revenue expenditure. So we have discussed this in the first tutorial. If the company has some maintenance expense or repairment expense, okay, let's say this is for a vehicle. Actually, they have two options, right? So they could capitalize this expense. So we call that as a capital expenditures. Okay, so the journal entry, we will have the asset, so vehicle in the debit side and then the cash credit side. So you can see from the journal entry, the asset value will be increased. Okay, and the second method is the revenue expenditure. Okay, so in the revenue expenditures, the company will record maintenance expense in the debit side and then cash in the credit side. Okay, so you can see the effect of these two alternatives. If the company use capital expenditures, they will report a higher profit. Why? Because they don't have maintenance expense in the profit and loss, right? So less expense means higher profit. Okay, and they will report a higher total asset in the balance sheet. Okay, because they capitalize the maintenance expense. Okay, and then if they choose revenue expenditure, so they will have maintenance expense in the debit, cash in the credit. So they will report a lower profit because now they have additional maintenance expense reported in the profit and loss, right? The profit will be lower and the total asset will be unchanged. Okay, so total asset will be the same as the previous accounting years. Okay, equal. Okay, so you can see from the different effect of these two alternatives, the company have incentive to choose this method. So the company have incentive to choose the capital expenditures method. Okay, because they can report high profit and high total assets, which is very good. Okay, so this is quite often happening in practice. Okay, so we always have issue whether capitalizing the expense or simply expensing in the current year. Okay, so this is also happening in Enron case. So they've been capitalizing the expenditures quite often. So the questions again whether this is ethical, right? So whether capitalizing the expense is ethical or unethical. Okay, so again we use this broad principle of accounting. Okay, so we have to check what happened with the vehicle, the asset after the maintenance, right? So the rule of thumb is if the maintenance expense is major maintenance, and after the maintenance the vehicle is improved, so the performance is improved and the productivity of this vehicle or the efficiency of the vehicle is improved, and we can believe that the economic life of this vehicle is extended after the maintenance, then capitalizing is the best option. Okay, but if we say physically the vehicle is not really improved with the maintenance, okay, because the maintenance only simply minor maintenance, okay, and the company choose capitalization because they want to report high profit, then that will be unethical. Okay, so again, this is all of them are legal, and we use our moral, actually, our moral or our basic accounting logic to evaluate whether this option or this choice is ethical or unethical. Okay, any comment or questions on the earning management? No? Okay, so now let's move. Okay, I think we have accounting principles. I'm not sure what you mean. Accounting principles. Can you clarify what you mean by accounting principles? Anna? Okay. Okay, so next, let's move to your homework. So I'm not checking this week's homework, so you don't have to worry. But you need to study the homework for the online quiz and the final exam. So the first one is exercise 3. So we have Jane Matthews, PricewaterhouseCoopers partners. It's contemplating the difference between conflict of interest and bias. As discussed within the objectivity principles, give an example of each from an accounting perspective and discuss how we might safeguard against these two elements. Okay, so the main idea is the bias is different with the conflict of interest. Okay, so bias simply means that the accountant become less objective or less stringent in doing the job. Okay, so it could happen because of various reasons. One of the reasons because of the conflict of interest. Okay, because the accountant have multiple interests, so it will affect their objectivity and also the level of scrutiny that they use when they do the audit or another job or engagement. Okay, so it could also happen because of the self-interest, familiarity, okay, or any other causes. Okay, and conflict of interest is simply because there's a multiple interests appear in the engagement or in the job, in the accounting job. So let's say this is an public accountant or auditors. If the auditor have other interests other than the public interest or the shareholders or the stakeholder interest, so you could get a biased decision, okay, or less objective decisions. Okay, so conflict of interest will cause the biased decision, okay, or biased judgment. So one of the important cause of bias decision or judgment is the conflict of interest. So in general, the accountant or auditor should avoid any conflict of interest. So if he or she has conflict of interest with specific client, then he or she should refuse to take the job or the engagement. Okay, so one easy example is if when the auditor or the accountant own some shares of the auditee or the client. Okay, so in the same time, the auditor also act as a shareholder. Okay, so in the auditor perspective, the auditor should act on behalf of the public interest, okay, or a wider shareholder interest, okay, in doing the job. But when he or she act as a shareholder, he or she will have incentive to report a higher profit, okay, or higher total asset in the balance sheet, right? So the price of this share will increase, and then he or she could get some capital gain if he or she decides to sell shares. So you can see there's conflicting interests when the auditor also own the shares of the clients. Okay, so this kind of conflict of interest will result in a biased decision. Okay, so biased decision or biased opinion. Okay, so that's why in broad or in general, if the auditor have some conflict of interest, he or she should refuse the audit engagement or any other engagement. Okay, any comment or question on the first exercise? No? Okay, so let's continue to the next one. So now we have departmental budget. So you are in charge of departmental budget. So you are a budget officer, and your CEO tells you to increase the requested costs in the budget to be submitted to the US parent company. It will allow her to better resource staff. She wants you to throw the additional budget costs into the project budget. So adding more budget to the project budget. Okay, as these are rarely questioned by the parent firm, the CEO explains that she does not want the money for her own personal benefit, but simply to look after staff better and provide them with more enjoyable work environment. Okay, so it's basically for staff budget. Okay, so to what extent are you acting consistently with the APES principles? If you request more fund in the budget using the method described by the CEO, is this even an ethical conduct? Please explain your answer with reference to the APES principles and threats. Okay, I think the main issue is that does the budget proportion, budget proposal or budget allocation is ethical? Okay, in this case. So if we refer to the standard, APES standard, we should start with the principles. Okay, so what principles may be at risk in this case? Okay, so I think we can start with integrity, right? Because the budget officer is asking for more budget which is not related actually with the project. So the budget actually is for human resource expenditure or staff expenditures. So it means the budget officer being dishonest, okay, and integrity principle may be at risk. Okay, so we have integrity problem. Okay, next is objectivity. Okay, so I think the CEO have some bias. So the CEO have some self-interest to treat the staff better using the project budget. Okay, so if the budget officer follow the CEO's instruction, then the objectivity principle may be at risk. Okay, and then the competence. So in general, the budget should reflect the activity, specific activity with being proposed in the budget. Okay, so if the budget officer propose some budget which is not related to the activity, okay, or the project or any other activity, then the head office will see that the budget officer is in competence of doing the budget proposal. Okay, so competence is also one of the risks of this case. Okay, and then lastly, the professional behavior. So by proposing irrelevant budget or expenditure within the project budget, so it means the budget officer acting unprofessionally. Okay, so can also put that the risk on the professional principles, professional behavior principles. Okay, so these are the principles, and then now we move to the threats. So what threats could be identified in this case? So obviously we have self-interest. So the CEO have self-interest to improve the well-being of the staff by using the project budget. Okay, so obviously we have self-interest. Next, we have familiarity. So because this project proposal or budget proposal is happening every year, so the CEO is already know that if the additional budget is proposed under the project budget, okay, it will be less scrutinized by the head office. Okay, so this familiarity is putting some risk in the breach of ethical principles. Okay, and then advocacy. Okay, so the CEO want to advocate specific improvement actually by improving the services to the staff. Okay, so this is a specific issue that she want to advocate. Okay, so it may also affect the objectivity and the integrity of this process. Okay, and lastly, maybe there's some intimidation involved in this case. So intimidation. So the budget officer may be being intimidated by the CEO if he or she did not follow the CEO's instruction. He or she may get fired or be transferred to another department. Okay, so we could expect there's some level of intimidation there.
So instead of intimidation, wouldn't it be self-service?
Yeah, it could be. Yeah.
Because it doesn't seem like an intimidation, but it's more like a self-service.
Well, there's a chance that the budget officer actually don't want to follow the CEO instruction. Okay, so the budget officer want to follow the professional standard, which is he or she should not request for additional budget, which is unrelated to the project. Okay, so it's not clearly mentioned in the question, but we could expect in this case that the CEO might use her power to direct this budget officer to asking for more unrelated budget in the project. Okay, so in terms
Oh
of,
yeah, it's CEO. My bad. Sorry, sir. I didn't read properly.
yeah. So we should follow the term of or the definition in the APES standard. So yeah, so we should follow their classifications of principles and threats. Okay, and try to explain this case. Okay, lastly, let's identify the safeguards. So what kind of safeguard that we could propose in this case to minimize the risk of this threat? Okay, so I think the first one should be the corporate governance, right? So the check and balance system should be strengthened, okay, to prevent any problem or any mistakes in the budget proposals. Okay, so corporate governance is crucial. Okay, and then next is the professional standard. Okay, so the budget officer should follow the professional standard. Okay, which is acting professionally with sufficient knowledge and skills. Okay, and yeah, and maintain the good conduct. And lastly, I think we can also propose the companies hire some external reviewer, okay, to evaluate the budget proposal and also the budget allocation process. Okay, so the company will get some independent and more objective perspective of the whole process, so they can make some necessary improvement if they need to do so. Okay, I think, yeah, so you can add more safeguard that we could propose, but I think the main safeguard that we could use in this case is these three. So corporate governance, professional standard, and external reviewers. Okay, so in overall, we should conclude whether this is ethical or unethical. Okay, I think it's quite clear from the case that this will be unethical conduct, right? So because the budget officer, if he or she follow the CEO's instruction, will propose an additional budget which is not related to the projects. Okay, so that would be unethical. Okay, and against all the ethical standard in the APES. Okay, any comment or questions?
Wait, sorry, sir. I'm kind of confused with the question. So is she the manager or the CEO? Because if she's the CEO, wouldn't she be able to make that decision? But unless the stakeholder doesn't agree with her.
So we have two actors in this case. So we have a budget officer, which is you. So you are in charge of department budget. So this you is actually the budget officer. So he is working under the CEO. So we have budget officer, the first actor, and then the next one is the CEO. So and your CEO, so we have also the CEO. So the CEO told this officer to add more, to propose more funding using the project budget. But in reality, the CEO is planning to use this additional funding for staff expenditures. Okay.
Yep. Okay, but that's why I'm still confused. Is the US
Okay, any other comment or questions on this problem?
Oh no. Oh, sorry, sir. I thought I was speaking. So what I was confused with is like, is that CEO the CEO of the branch or the CEO of the main branch?
I think this is CEO of this, it's not branch, I think it's a subsidiary. So the head office is in the US, right? The US is the parent company is in the US. And I think the CEO is the CEO of the Australian subsidiary of this company.
Oh, okay. That makes more sense. Thank you, sir.
Okay, so let's continue to the next one is problem 14. So in problem 14, we have a real case of a fraud case in ING and a very big financial company in the US. So we have an employee in the accounting department, Rajina Subramaniam. She's a senior accountant. Okay, so she illegally make 200 transfers to her personal account. Okay, so she transferred 200. She used 200 transactions to transfer the company's cash to her personal accounts, and then she used other company former staff logins to delete the record of the transactions and make the transaction appear legitimate. Okay, so this will happen. So the total fraud is 30 million. Okay, so we have 3 questions. So in your opinion, what could ING have done better in this situation? So if you read the questions, I think the most crucial problem is the company's internal control. Right, so the company's internal control is problematic. Okay, so I think you have learned this internal control in accounting A. Okay, so especially we don't see sufficient supervision from the supervisors to this employee. Okay, so we have lack of supervision. Okay, and we also see a lack of segregation of duties. So this employee is basically do all the payment process, okay, from receiving the invoice and then processing the payment and also recording the payment in the journal entry. Okay, so it's quite easy for her to make the transaction look legitimate or even delete the transactions from the record. Okay, so if we want to implement proper internal control, the staff which is responsible for processing the payment and the staff which is responsible to record the transaction should be a different person or different staff. Okay, so we will have check and balance there. Okay, and lastly, we see a problem in the documentation. Okay, so there's no proper documentation of every transaction or every process in this fraud. Okay, so this is the main issue that the company should improve in order to prevent similar cases happening in the future. Okay, so basically the company needs to improve their internal control. Okay, and now the next one, B, what principles or threats did the staff member breach? Okay, so let's follow the APES and then identify the principles that may be at risk in this case. Okay, so the first one, I think it's obvious that we have a problem with integrity. Okay, because this employee is transferring the company's cash to her own personal account. Okay, so we have integrity problem there. And then also we have problem with the confidentiality. Okay, because this employee could use other employees' access, passcode or logins information. Okay, so this problem with confidentiality principles. Okay, and then the professional behavior. Okay, professional behavior. So this employee is not acting in accordance with the professional behavior. Okay, I think that's the principles. What about the threats? What threats? Appear in this case? Obviously, we have the self-interest. Okay, we have self-interest. So the company, the employee have self-interest to steal the company's money. Okay, and then familiarity, because this process is happening for quite a long time, and the employee is very familiar with the process, so they can use the loopholes or the limitation of the process to steal this the company's money. Okay, and then yeah, I think it's two. Advocacy, I don't think we have advocacy. Yep. Okay, so this is threat. And lastly, what safeguards can ING put in place in the future to minimize the possibility of this occurring again? So I think, yeah, the key, I think, is improving the internal control. Okay, so the company should improve the supervision quality and then segregate the duties and put proper documentation in place. Okay, so basically improve the internal controls. Okay, so and they also could use a new system called the whistleblower system. It's basically a system where an employee could report another employee if they found any fraud or any misconduct. Okay, so the employee could report directly to the CEO or the head of the internal audit divisions anonymously. Okay, anonymously, and then so they will have less risk in reporting the incidents. Okay, so this system allow peer check and balance system. So every employee is being controlled by another employee. Okay, so now it's very popular in the company to have this kind of system. So whistleblower system. Okay, and that's pretty much. Any comment or questions? No? Okay. The next one is the discussion question. So the question is, discuss the distinction between ethical and legal conduct and why they matter equally in the accounting profession. Actually, it's not equally matter. So as we have discussed in the beginning, that in accounting, we care more about ethical consideration. Okay, so we care more about moral aspect of any accounting decision or accounting policy. Okay, because in general, everything every accounting policy or accounting choices is legal. Okay, so all the choices or policies is provided in the accounting standard. Okay, so which is very legal. So we don't really have problem with the legality of the choices or the policies. Okay, but typically we have problem in the moral aspect. Okay, in the morality of accounting choices or accounting policies. Okay, so in general, accounting information does not discriminate between legal and illegal because most of them are typically legal. Okay, but the moral issue may have some serious consequence of any accounting choices or accounting policies. Okay, so not really equal in the accounting professions. So we care more about the moral aspect of any accounting choices or accounting policies. Okay, any comment or questions on this discussion question? Okay, we still have 15 minutes, so let's discuss the extension question. So you can access this question on the UTS online. The question is quite interesting, so I think we can learn from this case. So the case is quite interesting. We have three actors. So we have the company, we have the auditors, and we also have the bank. Okay, so the company been audited by this auditor for quite a long time. I think it's more than 5 years. Okay, and the auditor found that the company is having problem in collecting account receivable from one big customers. Okay, and this affect their cash flow performance. Okay, so the company cannot pay the audit fees because of this failure in collecting the account receivables. Okay, so in order to pay the audit fees, the company need to get some financing from the bank, but the bank requires the auditor to issue unqualified opinion, which is the best opinion. Okay, so it's saying that there's no problem with this financial statement. Okay, so if I can summarize the case, so we have three actors. So we have the company, so it's the company A. We also have the auditors, and we have the bank. Okay, so the company, the auditor found that the company is unable to collect huge receivables from one client. Okay, so it will affect their going concern. So the company may have bankrupt in the near futures if they don't get financing from the bank. Okay, so and then yeah, so the going concern will be the main concern of the auditor. Okay, but the company, because of this failure of collecting the receivable, is unable to pay the audit fees because of shortage of cash flow. Okay, so they cannot pay the audit fees to the auditor. Okay, and the company requests some financing from the bank. Okay, and the bank is willing to give this company a loan, but the requirement is that the auditor should issue unqualified opinion. Okay, which is saying that the company has followed the accounting standard and there's no problem with this going concern. Okay, so it's basically saying that the financial report is okay. Okay, there's no material misstatement in the financial report. Okay, so this is the summary of the case. So if you see from this case, so you can see that every actors have their own self-interest. Okay, so the auditor have incentive to issue unqualified opinion, because if the auditor issue unqualified opinion, the company will get some financing and they will be able to collect their audit fees. Okay. And the company have some self-interest to get financing from the bank, okay, in order to keep continue operating. And the bank also have self-interest to give the money some financing. Okay, so you can see from this case that every actor have their own problems, which may affect the judgment or their behaviors in this case. Okay, so again, let's follow the standard. So let's identify what threat may appear in this case. So let's identify, let's start with the principles. Okay, so what principle may be at risk? So obviously we have risk of integrity. So if the auditor issue unqualified opinion despite of the going concern problem, then the auditor being dishonest. Okay, so we have problem with the integrity then. Okay, and also we have problem with objectivity. Okay, because the audit engagement has been happening for 5 years. Okay, so the accountant and company A become familiar. Maybe the auditor also know this, some of the bank officers. Okay, so we also have problem with familiarity. Okay, and bias which affect the objectivity. Okay, and then professional behavior. So the auditor, if they issue unqualified opinion, actually the auditor did not follow the professional behaviors standard. Okay, so it also put these principles at risk. Okay, now let's move to the threats. So what threats are in this case? So first we have self-interest, right? So the company, the auditors, and the bank, they all have self-interest, which may affect their objectivity, okay, in evaluating the case. And we also have problem with familiarity, okay, because this engagement or the schemes already happening for quite a long time. Okay, and then maybe some self-interest because, sorry, self-review. Okay, because this engagement is already happening for quite a long time. Maybe the auditor also found the same problems in the past. Okay, but because they don't want to put their past project or past opinion in or at risk, so they may become less stringent or less objective. Okay, so we have also problem with some self-review issue. Okay, and okay, I think that's all. So we have principles and threats. And lastly, let's propose some safeguards. So what safeguards could be proposed in this case? Okay, so I think corporate governance is the most important. So corporate governance, so in the bank or in the company and in the auditor firms should be strengthened. Okay, so corporate governance should be strengthened, and then the competence or the professional behavior should be strengthened. Okay, so this is the safeguard that we could propose in this case. Okay, so this is pretty much the case. Okay, and then lastly, what possible course of action should you take as the auditor? If you are the auditor in this case, in my opinion, you should issue a disclaimer or qualified opinion. Okay, because you have identified going concern issues within this company. Okay, so regardless of the condition, you should issue this disclaimer or qualified opinion. Okay, so yeah, so you follow the professional accounting standard behaviors. Okay, so you should highlight the going concern problems within this company operation. Okay, but you can also help the company to get financing from the banks by issuing like analysis of the company's liquidity or solvability. Okay, so yeah, so the bank can use this analysis to evaluate whether they need to give the financing to the bank, to the company. Okay, so you can provide like liquidity analysis, like providing like current ratio or quick ratio or any other ratio to give some real picture to the bank. Okay, that's pretty much all. So you can have another read on the case. You simply download the case on the UTS online. Any comment or question before we finish? Okay, just lastly, just want to remind you that the third quiz will be open tomorrow. Okay, so the quiz will cover the ethics and financial statement analysis. As usual, we will have 12 multiple choice questions for 36 minutes. Okay, so every student will have different questions. Okay, so and you only have one attempt. Okay, this is another reminder that tomorrow there will be information session. If you're interested to choose accounting as your major in your bachelor, okay, you can discuss with Nelson and Amanda the prospect and the requirement to do accounting as your major. Okay, any comment or questions before we finish? Okay, no question or comment? Okay, so I think we can finish the tutorial. So have a good rest and then you can start doing the quizzes. Okay, I'll see you next week. Thank you very much.